Morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday, April 19th. We will base these comments this morning on a report we released on the 17th titled Ready to Rip, which was a quote from Fed Governor Waller referring to the economy. This will serve as our weekly podcast. Also, a video. Our friends at Nucleus 105 will edit the video for us and attach some charts to it. It'll also be on our Ironsides YouTube channel. And I'm all dressed up this morning for a Bloomberg appearance in a short period of time. There were four sections to the report this week. The first section was titled Case of the Curious Treasury Rally. And we wrote about the drop in Treasury rates last week, despite strong inflation numbers and very strong economic data, particularly on Thursday, that had quite a number of people scratching their heads, though if you've been following our work, you probably wouldn't be quite as confused by the price action. The second portion of the report is Fed Vice Chair Clarida gave a speech last week that we think was a fairly important speech. It didn't get a lot of play in the financial press, but we think it has pretty important implications. He called it temporary price level targeting. So we'll come back and explain what we think that means for policy in a few minutes. The next section of the report we titled Closing the Nominal GDP Gap. And this was our recap of all the data last week and the implications for markets on a go-forward basis. And then finally, we wrote about the financial sector earnings that came out last week and what it means for profitability, the near-term outlook for financials, as well as the longer-term outlook for financials. So first, on the curious Treasury rally, we've been arguing all the way back since Jan and Feb that the real driver of Treasury yields this year is not the improving growth outlook, which definitely the growth outlook definitely has been improving. Inflation has been a secondary cause. Monetary policy is in there as well. But the real driver of higher rates was Treasury supply. This is the first time in our career in nearly 4 decades where we can recall increased Treasury issuance having to get repriced by the markets. And so the way we frame that out is looking at the 2s, 30s tips curve. That's the differential between that rate on the 30-year tips and the 2-year tips. And that 30-year tip rate really moved sharply higher and dragged the rest of the Treasury curve with it. That's important because the average duration of Fed purchases is only 6 years. So they're really not operating out on the back end. And from that January 5th Georgia Senate elections that ushered in the blue wave through the signing of the American Recovery Plan in the middle of March, you saw that curve steepen dramatically, and that was the real driver for rates. Once that process was complete and the American Jobs Plan was met with a much more lukewarm reception, the curve has stabilized and that repricing process is done. Now, if you also consider what's going on with policy at this juncture, we've got Fed asset purchases at $120 billion per month. So we've had a $1.7 trillion deficit so far this year. The Fed's purchasing roughly half that, but the Treasury has drawn down their general account at the Fed to the tune of about $700 billion. So that's injected liquidity into the system, into bank reserves. Some of that money's wound up in the Treasury market. So that's contributed to the market stabilizing. And the fact that the data is this good is a little bit of a dampening, or has a dampening effect on the Biden administration and Democratic government wanting to spend more money. So all of these things have contributed to the bond market stabilizing. And again, it's never really been all about data. Keeping in mind, though, that the inflation numbers are going up, and that will ultimately be the reason why we have higher rates through this business cycle. But again, the move so far this year has really been about Treasury supply. And so we're going to have to see how that American Jobs Plan and the plan that's coming after that progress. Those would be the catalyst for more high velocity moves in Treasuries. But count on the Treasury market stabilizing in here and rates starting to grind higher, because through that whole process last week, inflation break-evens, that's the market implied inflation rate, went up, not down. It was all in the real rate component or TIPS yield as to why the Treasury, nominal Treasury yield fell so much last week. So that's it on that. On this monetary policy issue and Vice Chair Clarita's speech, it was super specific. Now, he describes his strategy as temporary price level targeting. And the idea is, as long as there's a big employment gap, the Fed is going to target 2% inflation as a floor. So once they start normalizing policy, were the inflation rate to slip back below 2, this would imply they would stop or even restart easing. So it's a very aggressive stance. It argues for liftoff getting pushed back a little bit farther than some have talked about. Some think it could happen in June. We've been saying that meeting will be heated, but it won't likely start until later in the year. And once they get started, they're likely to be far more passive than they have been in the past. So the first two issues we talked about, real rate regime and the Fed policy stance, really does argue for our 60s analog and for being long the reflation beneficiaries within the equity market and across asset classes, and really counting on that reflation trade. Don't get carried away with buying long duration equities here. The tech sector, we want you to be market weight that sector. We want you to be long materials, energy, industrials, and financials, which I'm going to come back to in a little while. So on the data last week, we titled this section, Closing the Nominal GDP Gap. The tracking estimate on Thursday, after that strong data for first quarter GDP, Atlanta Fed is one measure, jumped from 6% to above 8%. It now looks like, based upon forecasts through the balance of the year, which have admittedly been too low thus far, that we will close that GDP gap from trend growth by the end of the year. We'll see how that goes with the labor market as well. Things we would note out of the retail sales numbers last week, there was lots of evidence that the lockdown's ending. E-commerce market share fell, for example. There was also evidence that the housing market is quite strong. Building product sales were strong. If you recall, we had some soft activity numbers in February. It was weather related, but some started to talk about rise in lumber prices, strong house prices, whether that would derail the housing recovery. The stocks have looked through that the whole way. We don't think it's going to derail the housing recovery because the demographic push from underneath is so strong, and we are going to have a very strong contribution from housing to the recovery in 2021, at least, if not for a couple of years through the cycle. We also got our first look at April Fed manufacturing surveys. The Philly Fed and Empire State survey were released. They showed very strong capital spending plans. If Richmond, Dallas, and Kansas City look similar, we will almost be back to peak business confidence around spending money on CapEx to where we were following the passage of the Tax Cuts and Jobs Act before the Trump trade war derailed that positive business confidence shock. So that's very good news as well. We also included in our report a long-term table to show you what CapEx looked like through the business cycles. The fact is, last business cycle was the longest cycle we ever had and one of the weakest capital investment cycles we've ever had. So there ought to be plenty of pent-up demand as long as the Biden administration's plans don't derail that by crowding out private sector investment. Jobless claims last week also showed some very promising results. In particular, the pandemic initial claims have plunged. They went to the lowest level they'd ever been to 2 weeks ago at around 150,000. Last week, they went to 130,000. Those numbers were around 500,000 back in January. So the gig workers, Uber drivers appear to be going back to work. It's a little early to make this call, but it looks at this point like the April payroll report could be another super strong blowout type report. That'll have pretty interesting implications even for the Fed, although again, we think they're going to look past strong inflation and employment numbers in the second quarter and really wait to see how things look in the third quarter. The inflation numbers all beat, right? PPI, CPI, and import prices, which is our favorite series because that's where we've been getting our deflation for 3 decades. Those are all going up. We're starting to show these on a quarter-on-quarter annualized basis. We're not going to show you year-on-year charts. Doesn't make any sense given how low the comps were a year ago, but they're all going up. Wrapping up this week would be the financial sector earnings. These were very much as we expected. Net interest income, net interest margins, and loan growth all disappointed. That issue with asset turnover, investors tend to look at the yield curve steepening and think that's a almost instant panacea for the banks, but it takes a long time to turn over their assets, particularly when loan growth is as sluggish as it is right now. Consumers flush with cash that they borrowed from their children via the government spending. But credit just was so much stronger than people thought. We're guessing that the street really didn't understand the implications of this accounting standards change, the so-called CECL standards that kicked off before the pandemic hit. It made it reserving for losses very aggressive, but it now means the releases of those reserves is very aggressive as well. Importantly, profitability, return on equity is tracking 9.75% right now. 10 is sort of our magic level. Above 10, the banking sector starts to build capital very rapidly, which they can return to shareholders. It was as low as 7.1% in the third quarter, was 7.3% in the fourth quarter. It's up to 9.75%. Back above 10 is very good news for the banks near term. We would definitely stick with them, though. When you looked at results last week and you saw the losses from Archegos and you saw the Coinbase IPO, it does raise serious questions about how the banks are going to deal with distributed finance in the coming years. All of the disintermediation type companies, and whether the banks will really have the right culture. To be frank, we think a lot of the innovation in the banking system died with the investment banking model in 2008. Lehman Brothers, where I worked, Bear Stearns and all the other pure investment banks. And the culture these days is far more tightly regulated and just not as dynamic as it once was. So you have to stay with the banks at this stage in the cycle, but long-term, we have our serious concerns. So that's it for me this week. Remember, rates rising will be ultimately because of inflation, but to get any shocks higher in rates, we need more government spending. Growth, the story is not about growth. It's about repricing for $5.3 trillion or 25% of GDP. That supply is going to pick up in the second quarter. There's still more money getting flushed back into the system from the Treasury general account. So we have a little policy battle going on. But if it looks like, and when it looks like the Biden administration gets closer to their next big spending package, you'll start to see the rates market react to that. And inflation is the real story. As it rises underneath, that will push rates steadily higher. So that's it for me. Have a good week, everyone. Barry Knapp, Ironsides Macro. Thank you.